Hey everyone, KYT here. I've been gone for a while, but it's not because the markets are crashing. It's because on April 25th, a bundle of joy was given to my wife and me. Her name is June, and it's been pretty busy, and it's been more challenging than I thought. I've heard of parents complaining about losing sleep and everything, and how it's mentally and physically taxing, and I've definitely felt it since I've been gone from this channel. Now let's kick it off with portfolio update, 144,000. It's pretty similar to what I had at the beginning of the year, and that's because, despite the market crashing, and that's because I've been depositing pretty aggressively, putting all the money in. I'm pretty proud that I've been able to max out my TFSA contribution limit. Now, because of the bad year, there are friends and family that might worry that they might say that they should have held cash instead of investing in the market, but that's always easy to say. That's hindsight 2020. I just make good decisions knowing that there are risks involved, and if you check out, I've shown this website a lot, the Canadian Portfolio Manager by Justin Bender. So you guys know, people on my channel know that I'm 100% XEQT, and in 50 years, the lowest one-year return was 37.74%. And if you check how XEQT is doing up to this point, it's down 17.47%. So it's within that range, and I've tried to explain to people that you're basically, when you're investing in something that has a positive expected return, but with some amount of variance, you are like a blackjack dealer. You're the house, you have a very small edge, and the house can definitely lose 12 hands in a row, but in the long run, and it's going to be positive. And historically, that's what has happened, and I just believe in the strategy. So it doesn't really matter if we've been getting crushed this year. Now, I want to build on top of my last video where I'm doing a series where I'm going really basic to help out those that know nothing about investing. So in that last video, I talked about the basic terms that you might run into once you log into Wealthsimple for the first time. We talked about market cap, we talked about stock price and stuff like that. So naturally, after you understand a bit about these terms and sort of how to buy and sell, naturally the question is, what's a good stock to buy? And KYT, why are you in XEQT? So there are two major ways to invest that I can think of. One is that you pick individual stocks. You pick your Tesla, your McDonald's, your Walmart yourself, or you go the KYT route, which is going 100% XEQT. That contains, if I can recall, 9,000 stocks across different industries. So it's about being diversified so that if one section tanks, you're okay because some other sector hopefully can make up some of the difference. Now, this is where I call out some of my close friends and colleagues that I've discussed this with, because some of them think that investing in an index in ETF like XEQT is wrong. It's a bad strategy because you just need to know a little bit about companies to be able to pick your individual stocks. And more often than not, these are people that generally just quote great investors that have done well for themselves, and that's great, but these people do not have the track record or the performance to justify their beliefs, to believe that they have enough skill to beat the market, to identify undervalued stocks. I call them out. It's like you're telling me an ETF is bad, but okay, show me in your 20 years of investing why you think you've been doing better picking individual stocks. And generally I get crickets. To better illustrate it, let's look at ARK. ARK had a great year in 2020. They had 152.52% return at some point. So let's look at the entire graph here. They had a huge spike, and then Cathie Wood, I think she had the best performance out of maybe all the funds that were out there, and that's why she was called Investor of the Year and stuff like that. People called her a genius, but in 2021, she had a negative 23.36% performance. And year to date, at least the stat that I see on the ARK website is minus 53.39%. But here on the Yahoo, it says minus 61.86%. So that's what I mean, that it's really hard. You have someone that the public thinks is a genius at stock picking, one of the best stock pickers in the world, which is, I don't necessarily agree with that because it's really impossible to tell off of 1 year, but let's just say it's true. And she's doing really bad this year. So this is why friends of mine who say all they need to know is understand a bit about the company and they know how to pick stocks. We have someone that people think is a genius doing really badly. So you are clearly undervaluing how hard it is to be a good stock picker. What makes it so hard is that most people I talk to, if not everyone, do not understand what the stock price represents. So if we go to, let's say, Pizza here. So Pizza, 12.08 Canadian. And you do a bit of research, you think it's a great company. But how do you know that $12.08 is a good deal? I mean, there's a lot of things that you have to do. You can't be a casual stock picker, again, that sort of, I don't know, knows that there's a lot of pizzas around and they're all profitable and etc. That's not enough. And there's a lot of companies, what people do, these stock pickers, is that they take a look at the revenue, the discount rate, a bunch of different stuff. And I mean, I think this is largely done for growth stocks. Like in this video, this guy's doing it for the Zoom stock. But the point is, there's a lot more work that is done to be able to match to this price and to see if you're getting a good deal or not. So the whole idea, the common advice that you might hear, just invest in good companies, that is just stupid advice, actually. I'm just saying, I'm a lot more aggressive in this video because I'm just tired of so many people just not understanding, being tricked by a lot of things that they hear from either other influencers or other sources. Like, it's not easy to pick stocks. Like, that's why people do it for a living. It's just a total disrespect that you think that you can, that an index ETF is a bad strategy. That's all I want to say. Now, I know I just often confuse people when I make sports betting analogies or comparisons, but I'll do it anyways for those that can understand them. When it comes to like investing in a good company, it's like believing you just have to bet on a good team, disregarding the price. So with the Stanley Cup Finals, you have the Colorado Avalanche against the Tampa Bay Lightning. The Avalanche are a very good team. They're considered the best team. But that doesn't mean that you should invest in them or you should bet them in the Stanley Cup Finals. It all comes down to price. So here it's minus 175, which means you have to bet $175 to win $100, which also means that they have to win 63.64% of the time for it to be a good bet. So how do you know that? Well, a lot of people, like myself, might have models that suggest if it's a good or bad bet. And that takes, again, a lot of work, a lot of information that you might not have. And it's beyond just knowing that a team is a good team. It's whether they are better than 63.64%. So going back to the Pizza stock, you're going to do more work to know if $12.08 is a good deal in order to have an edge over an ETF. And I've said this in a lot of my previous videos. This doesn't mean that I don't believe any of my friends can beat the market. But a lot of the times, their basis is based off of basically nothing. So this is sort of like my retort to them. And I think that's the end of this video. So that truly is the end of the video and shows why. I hope that explains why investing in some of these globally diversified ETFs is the way to go. And again, sometimes don't confuse every ETF to be the same thing. Most ETF are not an index ETF. They might be concentrated in a certain industry. What I mean by an index ETF is something like XEQT, ZEQT, VQT, or VGRO, like some that are not 100% stocks. Those are great as well. And that should be the starting point for most people. And that's it for this video. And despite the market doing bad, that's why I love recording these videos while the markets are doing bad, to show that doesn't deter me, or like it sucks. It sucks for my account, obviously, but it doesn't change the way I feel about my strategy. There's zero regret. I'm just going to continue to put as much money as I can into XEQT, and that's it. And we'll see in a few years. I believe I'm going to be right. So let's go.